In this video, I will show you the ultimate stock tier list. And once you understand this tier list, you will only invest in great businesses. My name is Christophe Nour. I've been investing in the stock market for almost a decade with a performance of 24% per year. And I use this tier list to only keep the best companies. So let's start from the beginning. Let's start from the E tier. You will see you have different tiers. You have the S tier, the best businesses. A tier, B tier, so average business, and you go down to E tier. So let's start from the worst category of businesses. In the E tier, you have the penny stocks, you have the SPACs, you have the speculative investments, you have the hype niche that are hype for only 2 months and then collapse. You have unprofitable companies. And I'm talking about all the things you see on Twitter, you see on Reddit, all the micro caps, small caps that are being hyped. This is literally a pump and dump scheme for big investors, and these stocks can easily be manipulated. So if you have the choice between thousands of companies, this is definitely the worst kind of investment for you. You want to invest for the long term in profitable companies that will compound your wealth, double-digit returns for the next 5 years, the next 10 years, the next 20 years. So my advice here is to avoid these companies at all costs. So if we zoom in, you have some examples of E-tier companies. The first one is Nikola Corporation. It was a buzzword a couple of years ago. It's an EV company, and if you look at the investor presentation at the time, they expected huge growth, huge potential, and if I put the stock price right now, you will understand that the story has completely changed. If I put, this is a complete collapse. In 2020, you see a stock went up. It's a 4x, and since the big bubble, it crashed more than 90%. 99%. They lost all their money. If you had invested in this hype stock, you would have lost all your money. It's better to avoid the situation, avoid the hype, and don't trust these sexy businesses. Okay, next one is AMC. Well, this is the same category as GameStop. Pure meme stocks, pure bad investment, speculative assets. So avoid at all cost, because these apes that buy these stocks make money in the short term, lost money in the short term. You don't want to be in this category of short-term trader. If you follow this channel, we invest for the long term with great businesses. So avoid. Don't try it out. Don't try to be smart and buy the dip before it goes to the moon. It doesn't work. It's just pure luck for a few of them, but the remaining investors, we are better off avoiding these situations. And same thing goes for Virgin Galactic. It was a SPAC, speculative, sexy business, but unprofitable. And I don't know the stock price of Virgin Galactic. Is Virgin Galactic right? Yes. And this is a SPAC, a recent company, and as all the SPAC, it went up a lot in 2020, 2021. Like all the SPACs, it was a double, and then it collapsed 99%. So if you don't want to lose 99% of your money, avoid these stocks. This is a E tier. This is speculative investments. I don't recommend investing in this ones at all. I have never invested in this one, and this is the reason I survived in the market. You want to make money in the stock market, but you first want to survive. If you invest in these companies, you won't survive. There is a high chance that you will explode. Okay, next category, we are talking about bad businesses with bad management. So this is D tier. This is not if you had to avoid sectors, companies, avoid the D tier, avoid the E tier. Okay, now let's talk about the D tier. These are bad businesses, bad management. Literally, you have falling knives, bad companies, decreasing revenue, decreasing earnings. The CEO is leaving the company. You have Intel, for example. They are struggling, difficult environment, competition is harsh, and revenue is declining. Earnings are declining. They have changed 3 times the CEO of their company in a couple of years. This is a red flag. So Intel is struggling. Avoid this kind of business. You have GE, General Electric, that once was a darling in the 80s, and now it's a big conglomerate. So they try to do some spin-off and they try to survive. If a company's main problem is to survive, that's a very bad sign. You don't want to associate with companies that struggle to survive. You want to associate and invest in companies that are getting better and better and better and better for the next 5 years, 10 years. You don't want to invest in companies that struggle to survive, and even for your stress. I mean, you will have sleepless nights if you invest in these kind of businesses. So just for your mental health, avoid this kind of investments. Same thing for Bed Bath & Beyond and for WeWork that went bankrupt. These are bad business models or big conglomerates that have become complacent, bad management. And you can see it with the numbers. I mean, when you see the revenue going down years after years after years, earnings going down years after years, that's a falling knife. I mean, if the problem has not been solved in 3 years, 5 years, that's a red flag. It's just that they have been eaten by competition. They have been eaten by the industry, and if you had invested in these stocks, you would have lost a lot of money. Okay, now we are talking about better investments. Now let's talk about the C tier, the average business. You can make money in this business. You can make money in these businesses if you invest in these stocks. It all depends on valuation. We are talking about average businesses, not speculative assets, but not great compounders for the long term. So Ford, so vehicle company going into EV, losing a lot of money with their EV branch, but this is a renowned brand. This is a renowned company and operations are still solid. You have 80. The stock has been declining for years and years and years, and they pay a dividend like I don't know. Let's check the AT&T. They pay a nice dividend, I think, 5% dividend yield. Yes, but the stock has gone nowhere for 20 years, so it's a complete mess. That's why it's an average company. You have Kraft Heinz. So literally, Warren Buffett admitted that they overbought. The price was too expensive when they bought, and it was a mistake for Heinz. I mean, and yeah, it was a merger. It didn't go very well. The growth is not here. The profitability is not here. So this is an average company. You won't get extremely good returns with these companies. I'm telling you. Same thing for GM, General Motors. If you had invested in GM 20 years ago, you would not have made a lot of money. If you check the stock price of GM, flat. It's stable. So if you want 20% returns year over year, don't invest in these average businesses. And putting them at the average, in the average category, because you can still make money depending on the cheapness on the price action. For example, you can invest at the COVID lows and sell at 2021 and make a quick triple. Or you can invest here, October 2023, and sell just when it rebounds a little bit. So you have a quick double. But for the long term, avoid them. For the long term, this is not worth it. The stress is not worth it. And yes, the stock is cheap. Yes, they have a dividends. Yes, they are famous. Yes, operations are here. But if you want to invest for the next 10 years to compound at double-digit returns, this is not the stock you want. This is not the stock you want. So yeah, it depends on the valuation, but I have never invested in an average business like this. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of this video. Now, the quality of the companies is going up a lot. Now we're talking about the B tier. The B tier, these are good businesses with a decent moat and an okay management. That means Nike, they have some issues, they have some struggles. They changed the CEO recently, but still they have a good brand. Operations have been solid for the last decade, and we have some short-term issues. So if you look at the stock price of Nike, you see some weakness in the short term over the past few years. But I mean, you have a good business. If you had invested in Nike 10 years ago, you would have made money. Revenue is growing, net income is growing. It's just that they have a temporary problem with their business model. B2B, B2C, etc. But this is a decent business, good business, with a decent moat. Okay, next one is P&G, Procter & Gamble, famous company. They sell everything, so you will get a good return, but don't expect more than 10% returns. If you invest in Procter & Gamble, you can get 7% return, 8% return. Okay, that's fine. Same thing for McDonald's. So temporary issues, small problems here and there, but this is a well-run company. It works well. After this, you have Adobe. Adobe, I'm putting here in the good business. It's a better quality business compared to the other ones, by the way. It's a good business, good moat, and management is decent. They are not excellent. I would not say the business is 100% sure to be better in 10 years, but it is a good company. The moat could be an issue with AI generative images, so maybe a competitor will eat their lunch, but Adobe generates more revenue every year, more earnings every year. So this is a good business, good management, a good direction. If you invest in Adobe right now, you can get good returns. And the final one is Coca-Cola. Everybody knows Coca-Cola. This is the famous bet of Warren Buffett. So this is a typical investment that is safe for the long term, that will be here in 10 years, 20 years, but the growth is not really there. The growth is reasonable. It will grow 5%, 6%. They will give you some dividends here and there, but that's it. You won't get 20% annual returns if you invest in Coca-Cola. This is a large business that is heavy to move, so operations are slow. But yeah, this is a decent business, good business, decent moat, okay management. This falls completely in this category. Okay, now we're talking. Now I like it a lot. Now we are talking about the 8 tier. Businesses with a wide moat, a great management, and a strong growth potential. We are talking about Amazon. We are talking about these kind of excellent businesses that you want in your portfolio. You absolutely want to invest in these businesses if you want to invest for the long term, because these businesses have shown some resiliency. These businesses have shown that they can grow earnings, they can grow revenue for a sustained period of time. So that's one of the best investments you could make in the stock market, to invest for the long term. So you have Amazon, you have Ferrari. I mean, they can double the price of their vehicles, of the cars, and still people will buy them. So this is an unbreakable business model. This is a wide moat, great management team. They understand the value of the long term, of the brand, of the user experience, and strong growth potential. The pricing power for Ferrari is enormous. They can increase the price of their vehicles 10% every year, 10%, and people will keep buying more and more. There is a backlog of 2 years for Ferrari cars. In other words, when you want to buy a Ferrari, you have to wait a waiting line of 2 years. You have to wait 2 years before buying your Ferrari car. So that's a great business model, great moat, and most of the buyers of Ferrari cars are already owners of Ferrari cars. So you have an inner circle that is rich, wealthy, and they will pay. So wide moat, great management, strong growth potential. Next one is meta platforms. You have Facebook, you have Instagram, you have WhatsApp. You have an untapped potential because of the monetization that can grow and grow and grow with the advertising, etc. This is a flywheel, beautiful flywheel. They have 3 billion people using their services on a monthly basis. You have one of the top 10 businesses of the world here. Same thing for Google, by the way. I put them in the same category. A lot of cash. They almost have no debt. They do buybacks. Management has a vision and uses it smartly. These are businesses that will be stronger in 5 years. So literally, this is some very, very good investments. Be careful of valuation though. These businesses can trade at a higher valuation. For example, Amazon or Ferrari, they are not trading cheap. So you want to buy them at a cheap price, at a reasonable price or cheap price. Say a PE ratio of between 20 and 30. So this kind of valuation, or price to free cash flow between 20 and 30. It doesn't happen very often, but if it happens, and it will happen, it happened in COVID, it happened in 2022, it happened even before, it happens. So take advantage of the opportunity and buy them at a cheap price. So yeah, okay. And the last one is Nvidia. Same thing. These are businesses. This is a business with a wide moat, great management, great vision, and strong growth potential. This one is very, very true. If AI takes over the world, and if AI will be implemented in everything in 5 years, Nvidia will be the leader. Nvidia will have enormous earnings, huge growth. So literally A tier, even in the S tier category. But about the moat, I'm not sure about Nvidia. I mean, maybe a competitor will come. I'm not an expert in this category, so personally, I'm not comfortable putting Nvidia in the S tier category. S tier, you will see, these are businesses that are impossible to kill. These are businesses with the widest moat. They will be dominant for the next decade. They will be dominant for 20 years. These are the best businesses, in my opinion. Again, this tier list is based on my personal experience. If you want to invest in businesses that will be here for 10 years, growing revenue, growing earnings, just focus on the S tier. S tier. Okay, reveal. The S tier, we have excellent business models. Maybe one of the top 5 business models I have ever seen. This kind of stuff. This is very impressive what they have managed to do before. The first one is Texas Pacific Land, TPL. I have done a stock pitch on my YouTube channel. They own some land in Texas, and they have been here since 1888, and they generate more revenue, more earnings, because it's a royalty business. They have 90% gross margins. They are unkillable. Nobody can take away their lands, so their moat is untouched. You can't kill them. You can't touch them. So yes, you have some volatility. Yes, it's ups and downs. But over the next 10 years, 20 years, I can almost guarantee that it will be a better business. So over the next 20 years, I can almost guarantee it will be a better business with more revenue, more earnings, and it's impossible to kill. They have been there for more than 100 years. That's impossible to kill. Beautiful moat. The second one is FICO, Fair Isaac Corp. They do FICO scores in the US. So that's for mortgage, that's for lending, and they have such a monopoly position, and they are so entrenched with the US banking system that nobody can touch them. Nobody can kill them. They have tried before. They have failed. They have tried before to have some competition with the Vantage score 10 years ago in 2014. They failed. A new company, Upstart, AI company, started to do their scores with AI cheaper. They failed. Literally, nobody can touch FICO. Nobody. The only problem I have with FICO is the price. You have a PE ratio of 100, so that's a lot, and that's not in the buying territory for the moment. But they have untapped potential, immense pricing power, beautiful margins, and I'm very, very confident there will be a better business in 10 years, 20 years. Maybe there will be some regulation to cut the different business models like we see for Google, like a breakdown of the business model. That's the biggest risk. But apart from this, competition is not a risk. Inflation is not a risk. Interest rates are not a risk. Geopolitical conflicts are not a risk. Nobody can kill FICO. So this is definitely in the S tier. Also, you have Visa. Visa, this company doesn't care if the world is going well, the world is not doing well. They will take a transaction fee. They focus on what works. They don't care about inflation. They don't care about interest rates. They are focused on international markets. They focus a lot of free cash flow, a lot of earnings, a lot of more revenue. And I can bet that in 5 years, 10 years, this will be a better business. It's in the S tier. You can't kill Visa. Same thing goes for MasterCard. You can't kill them. They have beautiful margins. They have been growing free cash flow per share 20% annually for the past 10 years, 20 years. The PE ratio is about 30, 35, so that's reasonable, a bit expensive, so you maybe wait a little bit. But these are beautiful business models that can't be killed. Okay, next one is the easiest one, Berkshire Hathaway, the conglomerate of the giants, Warren Buffett and Charlie Munger. You can't kill this business model. This is a conglomerate of $1 trillion, and they are in everything. This is one of the most well-run business in the US and in the world, with the best capital allocator in the world, Warren Buffett. It's hard to kill Berkshire Hathaway. It's very hard, and they have been in business since the 60s, so you can bet that for the next 20 years, they will continue to grow. They are built to survive. They are built for the long term. So in the long term, they will continue to thrive. And they survived everything for the last 60 years. So yes, I think Berkshire Hathaway definitely is in the S tier category. The last one is Costco. Costco is built as a big flywheel. This was the favorite investment of Charlie Munger for all reason. It's definitely one of the best business in the world. And the way it works is scale economies shared with Costco. They have low prices, customers are happy, customers buy more, so you have more volume, and because you have more volume from your suppliers, you can buy from your suppliers at a cheaper price. So you reduce your cost, and then you can sell more. It's even cheaper for the customer. Customer is happy, they buy more, so you have more volume to buy. More volume to buy, cheaper, etc. And as you grow, you have an immense flywheel with immense customer satisfaction, with immense recurring revenue with their card from the customers, the membership card. You grow your price exactly like Amazon. Even Amazon actually could be in the S tier category, but Costco is a brick and mortar store, well established, and they tap into the Chinese market. They grow slowly in the Chinese market. They want to do things safely for the long term. So, I mean, you have the ex-CEO Jim Sinegal that has built a vision for the company that is so extreme of low-cost producer. The customer is king. This vision is so clear that they did this for the past decades. They will continue to operate in the same way for the next decades. The only problem I have with Costco is the price. Once again, this S tier business, the problem is everybody knows these are S tier businesses. So they pay a huge price to own these high quality assets. The PE ratio is 50. And yeah, look at this. This is some unbelievable chart you could get. One of the best charts you could get in the stock market. If you had invested in like 40 years ago, 1984, you would have made a lot of money. A lot of money. So yes, as a long-term bet, this is fantastic. So here you go. This is the tier list of stocks if you want to invest in low quality stocks or in high quality stocks. So if you only want to keep the best one, focus on S tier, A tier. And if you are risky and you want to lose all your money, focus on the E tier and D tier. But personally, I will only focus on S tier, A tier, and B tier only with good valuation. That's my advice for you here. Focus on the quality assets, because these quality businesses have been winning for years, winning for decades. There is a high chance that they will continue to win for next decade. So literally, the past is a very good indicator of the future. If the business has been struggling for the past 5 years, this is very likely that they will continue to suffer for the next 5 years. Turnaround plays rarely turn around, as we say. So S tier, A tier, and B tier only at a good valuation. That's it. If you like this content, I have an investing coaching program to make you a better investor. In this coaching program, you will learn a complete investing process. You will learn how to find stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. So what comes with the coaching program? You will get access to an exclusive community of like-minded investors, and you will get my personal guidance to help you build the portfolio of your dream so that you can have long-term results with your stock portfolio. Click the first link in the description to get more information. You will get a 10-minute video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.